Hi, Harry here with the rant for April 5th. Well, the jobs numbers came out this morning a little stronger than expected, and I would have thought the stock market wouldn't like that, but it looks pre-open that, they're going to be up a little bit. What's important here, folks, is we are in and have seen the longest, greatest stimulus program in history ever since 2009. $27 trillion in fiscal and monetary, 19 of that fiscal, 8 of it monetary, okay? This is what's kept an economy out of what have been a long-term generational downturn from 2008 to 22, okay? But there was a price to it, $27 trillion again, and nobody else is telling you that, okay? So the $1 trillion question now is, how do we pay for that? We're at a point, and of course I've been predicting this for a long time, not just a long downturn after the baby boom from Generation X spending less, but the millennials kick in right about now, 2023, 24 into 2037, okay? So we should be entering the next boom. The problem is all of this stimulus has kept us from clearing all the bad debts, and we have bubbles in stock markets, a second great bubble that has not even begun to reverse yet. So I still think, and this is really unusual here, just when the demographics get positive again, we haven't detoxed our debt and financial asset bubble. So there's still a very high chance that's going to have to happen in the next year or two, and that's what we have to prepare for as investors. Now, since we've been living off stimulus since 2009 and not fundamentals, the whole trick is, okay, how does this work out? And the problem is in the lags, okay? Traditionally, it's seen that when the Federal Reserve stimulates the economy or tightens like they did, okay, more recently, it takes about a year and more like a year and a half to hit. You know what I'm seeing now? That first stimulus that peaked in March of 2022 was still hitting up until recently, okay? So that lag with the magnitude of this stimulus could now be more like 2 years. Now that means now on the other side, since they tightened between March of 2022 and July of 23 and have kept that tightening at those levels. So they have not eased yet, and that's why the markets are looking at this data and how are we doing, because they want to know when the Fed's going to start easing again. Well, that doesn't look likely after the job numbers this morning. And so that's where we get in trouble. That all of a sudden the markets could start saying, oh my gosh, they're not going to ease, and the markets start going down again, and then that gains momentum before the Fed does ease, June at the earliest, which they've said, but it could be later now in the summer, and then the stocks drop enough to start to get consumers scared about the economy and the markets. And that's when the markets start to take over from the central banks. And that's what I want to see. I always have to remind everyone, this is the greatest tightening since 1980 to 81. And that caused the deepest recession since the Great Depression back then. So this is serious business, and it doesn't seem to have hit enough yet. But again, I think the magnitude of this stimulus may be increasing the lags here, okay? So this looks like, again, the final time for people who are not already out of stocks, and most people following me are by now, but it looks like the NASDAQ may have peaked possibly here on March 21st, and the S&P 500 following that on March 28th. We won't know for sure, but you can't be exact about picking a top like this. This is a time to get out, and this is, of course, the time to be in the safe havens. And remember, gold is not it. It's not the worst place to be. Back in 2008, gold kept edging up in the early part of that recession, but in the end, in the second half of 2008, it went down 40% or more and was not the best safe haven. In fact, it wasn't a safe haven, but it wasn't the worst place to be. It is the 10 and 30-year Treasury bonds. It is ETFs like TLT. This is the time to be there and be out of stocks. And if we're a little early, so be it. But the odds have just increased that we've just seen a top in the stock markets, and it's going to take a year to two for this to play out, and possibly longer. Remember, this is unprecedented. They've never pushed off a downturn this long. How ferociously the markets react in this window where the Fed is not easing yet and may be delaying that, the more likely this is to happen. I'm just going to have to keep you updated on this.